I'm very bullish on REITs, and that's not a secret to anyone who follows my work. They are today priced at their lowest valuation since the great financial crisis, and historically it has always been a good idea to buy REITs when they were offered at such low valuations. Therefore, I think that this is a once-in-a-decade type opportunity to win big, and I've positioned my portfolio to profit from this opportunity. However, that doesn't mean that every REIT is worth buying. This is a vast and versatile sector with over 1,000 companies worldwide investing in 20 different property sectors, 30 plus countries, and so just because I'm very bullish on certain types of REITs doesn't mean that I'm buying just any of them. Hey everyone, this is Jussi. I run a small investment firm that specializes in REIT investing. In today's video I'm going to talk to you about 3 popular REITs that I would consider selling today. But before I get into it, I wanted to remind you that we just recently launched a new YouTube channel to discuss all our favorite non-REIT investment opportunities. It's run by Samuel Smith, who's VP at our company. He's an expert in MLPs, BCDs, closed-end funds, yieldcos, and other high-yielding vehicles. And he just recently posted a video on some of his favorite investment opportunities. I highly recommend that you go check it out and subscribe to the channel. So the first REIT I will consider selling is called SL Green, ticker symbol SLG. This is a very popular REIT among individual investors because it owns skyscrapers in Manhattan for the most part, and these properties are perceived to be highly prestigious. It's also offering a monthly 6% dividend yield, and its valuation is today historically low. Bullish investors are here arguing that Class A office buildings are here to stay and that the market has overreacted to the threat of remote work. And because of this, they believe that the recent market crash is unwarranted and that we will see an epic recovery in the coming years as the company keeps proving the market wrong and while you wait, you're earning a safe and growing 6% dividend yield on a monthly basis. I actually think that this is a pretty decent investment thesis. I agree that Class A office skyscrapers in prestigious locations like Manhattan that are supply constrained are likely to do relatively well over the long run despite suffering at the moment. On top of that, I think that SL Green has amazing management. I really like their recent move into the asset management business. They've been selling a lot of equity interest in some of their properties to other investors to start earning fee income and to also unlock value for shareholders. I think it's a brilliant approach for them. However, there are still some holes in the investment thesis. The first one is that SL Green has already appreciated a ton from its lowest point. It's up about 150% from its lowest level, and so yes, it's still down over the past few years, but it's not nowhere near its lowest point anymore, and so its valuation might have been very low. Today it's not that low actually anymore. I'll come back to that a bit later, but yes, and this surge happened even as most other REITs stagnated for the most part, so relatively speaking, compared to other REITs, it has now become quite a bit less desirable. And then secondly, while I agree that Class A office properties are here to stay, I still think that they will face significant pain over the coming years because the office market is today in a severe state of oversupply. The average occupancy rate of the office sector is today just around 80%, which is the lowest since the great financial crisis. This means that there will be intense competition for tenants in the office property sector, and landlords will likely have to offer large concessions, tenant improvements, and even reductions in rent levels. This is well reflected in the recent results of SL Green as it saw its occupancy rate dip into the 80s for the first time in a very long time, and its rents on new leases also dropped by right around 5%. And unfortunately for SL Green, I think that this cycle of oversupply will last for quite a long time because today still a lot of tenants are under long-term leases, and as those gradually expire, they are now leasing less space as they move into a hybrid work setting which requires less space. Moreover, I also expect many of the lower quality Class B properties in Manhattan to change hands in the coming years as previous owners default on their loans and new owners that are better capitalized come in, heavily reinvest in the properties to get them to compete with the Class A properties, and so this is going to hurt REITs like SL Green even further. It's going to force the REIT to keep heavily reinvesting in its properties and offer strong concessions to tenants to compete in this marketplace, and therefore I think that its current cash flow level is actually quite a bit lower than what it may seem on the surface. And then a final point I want to make about SL Green is that it's 100% exposed to New York City, which is a particularly expensive market with very high rents, very high taxes, regulations that are not particularly business friendly, and as a result, a lot of companies are now moving down south to Florida or to Texas. Simply moving your company's address can allow you to significantly reduce your business cost and your taxes, and so a lot of companies are making this move. I expect this trend to continue going forward, and that's another disadvantage for SL Green. Despite all of this, the company is quite cheap. I agree with that. It's priced today at about 9 times its forward AFFO. That's not particularly expensive, but there are many other REITs that are, in my opinion, a lot more resilient that are priced at similar valuations, and therefore I don't see the point of owning SL Green today. Hey, before I go into the second REIT, can you please do me a huge favor and click the like button if you think that this content is valuable? That will help me a lot to grow this channel. Thanks so much in advance. Then the second REIT that we'll consider selling is called Host Hotels and Resorts. Its ticker symbol is HST. This is the biggest hotel REIT in the world. It owns some amazing properties. I'll put some of them on the screen right now. I think that the company will do fairly well over the long run. It's not very expensive. It owns great assets, has a strong balance sheet, it has a pretty good track record, and I think it's also well positioned to take advantage of weaker landlords that are perhaps over leveraged in the coming years as they default on their debt. However, I'm not a big fan of the hotel sector in general. This was the least rewarding property sector over the past 30 years, despite also being one of the most volatile, and I think that this relatively poor performance relative to other property sectors will continue going forward because of all the following reasons. Firstly, it's a highly cyclical sector, and I think that we are today closer to the end of the cycle rather than its beginning. Secondly, it's highly competitive. Then thirdly, it requires a lot of capex because you constantly have to keep your rooms, your property in great shape to attract consumers. Then fourth, I think that the third-party booking websites will keep on taking a larger share of the revenue. Then fifth, Airbnb is likely to keep on growing as well, stealing market share from traditional hotels. Then sixth, Zoom has really taken off following the pandemic, and this has resulted in a drop in business travel, and I don't see this reversing anytime soon. And then finally, I also expect some office buildings to be reconverted into premium hotels in great locations, increasing the supply of hotel rooms, hurting existing property owners. All of this doesn't bode really well for hotel REITs, and yet Host Hotel is today priced at a similar valuation multiple as other REITs that are focusing on stronger property sectors, and therefore I don't see the point of owning Host Hotel. Again, I think that the REIT will do relatively well over time. This is not a call for you to short the REIT by any means. I'm just making the point that I think that some other REITs offer better risk to reward at this time. And then the third REIT that we'll consider selling actually isn't a REIT, it's a REIT closed-end fund. It's called Cohen & Steers Quality Income Realty Fund. It's very popular among individual investors because it's offering diversified exposure to the REIT sector with a monthly 8.2% dividend yield. That's quite a bit more than what ETFs like the Vanguard Real Estate ETFs are today offering at closer to 4%. However, I actually think that the Vanguard Real Estate ETF is a better vehicle for passive investors, and there are a few reasons for this. The first issue here is that the high dividend yield is simply the result of the leverage that the closed-end fund is using. And I think that this is a bit of a problem because remember that REITs are already using leverage at the company level, and so they're essentially adding a second layer of leverage on top of that, and that can be quite dangerous in the event that we see another black swan. The performance of this closed-end fund during the great financial crisis is a great example here. The company almost went bankrupt. It dropped by about 90%, and I think that we're gonna see other black swans in the future. I don't know exactly when, obviously, but I don't see much point in earning a high yield and good returns for 5 years if then on year 6, because there's a black swan, let's say China invades Taiwan, we see the share price of the company drop by 90%. I think this is simply the result of using too much leverage, and that's not what I'm interested in. And then the second issue is that the active management of this closed-end fund has not really been enough to earn alpha for shareholders. They've only managed to outperform their unleveraged benchmark by about 30 basis points per year after fees over the long run since their inception. And that's really not, in my opinion, a good deal because remember, you're taking much more risk in the form of leverage, concentration, active management, and yet you only earn slightly better returns. I think that investors would enjoy better risk to reward by simply sticking to an unleveraged low-fee ETF like the Vanguard Real Estate ETF. Once again, this doesn't mean that RQI, which is a ticker symbol of this closed-end fund, will perform poorly going forward. On the contrary, if we see a strong recovery in the REIT sector, as I expect in the coming years, I think that this closed-end fund will richly reward shareholders because it's leveraged. However, I just think that the risk to reward here is worse than those of its unleveraged benchmarks. Hey, if you're still watching, let me know in the comment section below what REITs you think are better investment opportunities than these 3. Also, please click the like button, subscribe to the channel, that helps me a lot. And then finally, if you want to access my entire real money REIT portfolio, you can do so by joining High Yield Landlord, which is my REIT newsletter, for a 2-week free trial. This means that you will gain entire access to my portfolio, all my trades are lodged in real time, at no cost for the first 14 days. If you have no interest in the service beyond that, you can simply cancel. You won't be charged a penny. Thank you very much for your support and see you at my next one. Bye bye.